Eurodollar is a system, it's a monetary system that arose in the 1950s. And to be perfectly honest with you, nobody knows where it came from. It just kind of showed up during the middle 1950s, late 1950s. One of the first observers, a guy by the name of Paul Einzig, said, I stumbled across it by accident in the late 50s. And all the bankers who were trading in these US dollars outside the United States told him, they begged him not to write about it because they were making so much money in this offshore market. So essentially, Eurodollar means offshore dollars. That's what euro means. It's not about the European common currency. It means offshore. So if you see the term euro yen, that just means offshore yen. That's the amount of Japanese currency that's traded outside of Japan.
Right. You should think of it as almost non-US US dollars, right?
Exactly. Except there are no US dollars either. That's the other trick. So it's offshore, it's outside. And when I say offshore, it's offshore everywhere. I don't mean that physically, but I mean in terms of jurisdiction, in terms of regulation. So if you're a bank in the Cayman Islands, you go to the Cayman Islands where my podcast co-host Emil Kalinowski lives, there's trillions upon trillions of dollars there, and there's all sorts of massive banks there, but you'll see there aren't any banks or dollars on the island. It's all simply fictional. It's all virtual. It's all ledger money. So there aren't physical currency. It's not like there's pallets of actual Federal Reserve notes being traded. There's no gold, obviously. It is all basically ledger money, and it's a distributed ledger that is kept by the global banking system. Essentially IOUs, if you want to put it that way. Banks that trade IOUs all over the world, instantaneous settlement, elegant solution to Triffin's paradox in the 1950s. And then because it was offshore, because it was banks being able to freely experiment with all these monetary forms, it has simply evolved over decades when nobody was monitoring, watching it, let alone regulating it, to what we see today, which is unbelievably complicated. And as you said, Adam, it's not like this is a niche market. This is not like a little thing. And in many ways, and in many respects, it's wrong to think about it as if there are two separate dollar systems, as if there's this Eurodollar system and then there's a domestic dollar system. It's really all Eurodollar. And the Eurodollar system is so unbelievably huge, we have absolutely no idea how big it is. Some of the last known that I know of, the last estimates for how big the Eurodollar system had become go back to 1988, and then they stopped there. A company by the name of Morgan Guarantee used to try to keep track of what they called the euro currency market, which wasn't even the whole thing. It was just the amount of offshore money that they could keep track of. And they stopped in I think it was March of 1988 because they said, we can't keep track of it. But even so, in March of 1988, they estimated that the Eurodollar currency that they could identify was about 50% more than the entire domestic money supply at that time. So even in 1988, more Eurodollars that were just visible than the entire domestic money supply that anybody, and I'm talking about M1, M2, M3, everything that could have been identified in the monetary aggregates in the 1980s, there was still more of it outside the US. And then, of course, you have to believe in the 90s and 2000s, it just went exponential, parabolic growth. That's how we ended up with something like the housing bubble in the US, corporate credit bubble around the rest of the world. Essentially, the Eurodollar system was responsible for all of that.
So a couple more quick dots to connect here, which is, so as I understand it, there's really sort of two ways in which currency can come into existence. The Fed can create it, but also the banking system loans it into existence. And we have a fractional reserve banking system, which means that, you know, I can take in $100 as a bank and I can loan 90% of that out. And then those dollars, as they get redeposited in banks, can then be loaned out again. So there's sort of a multiplicative effect here. Is it true that Eurodollar is pretty much the same way, meaning a Eurodollar gets brought into existence because somebody makes a loan denominated in dollars outside of the US, and then the repayments on that, the interest that's charged on that, all that is basically money that's being created, dollars that are being created out of thin air. Is that correct?
Yes, this is all bank assets and liabilities. So it isn't even if there's cash in a vault like in a traditional fractional reserve system. In a traditional fractional reserve system, you can't multiply something you don't have in the vault, right? You have to have at least some cash in order to make multiple claims on. That's where the Eurodollar system really gets complicated and weird, because there isn't even physical cash there. So it's governed not by the amount of cash in the system, because there really isn't any. It's governed by the bank covenants and some of the internal constraints on bank balance sheets. Because essentially, as you said, there is a multiplier effect, but what we're multiplying isn't cash, it's claims on cash. It isn't physical Federal Reserve notes. It's claims on another bank's ability to get them if ever they were required to. But nobody ever wants to convert to cash, because you think about who operates in the Eurodollar system. It's either other banks, other financial institutions, non-bank financial institutions, or corporate customers. None of those participants want physical cash. It's not like you or I would want to hold physical cash in our pocket because we choose to have that form of liquidity. Everybody is okay with operating on a cashless basis because they understand the rules of the game. They understand how everything works. Whereas you or I, this is all just, this is all opaque. It's all very hard to understand. And so we're kind of starting at an information disadvantage as well as a positional disadvantage, because we're not really allowed to participate in it. But it is essentially like a fractional reserve multiplication effort, except for the fact we're not multiplying actual cash. We're actually multiplying claims on cash.
If you enjoyed this clip, you can watch the full video it's from by clicking here.